Hello, folks. Brett Pattison with Iron Gate Global Advisors coming at you from the financial capital of the West. That, my friends, is the beautiful city of Salt Lake City, Utah. I'd like to welcome you to our Market Minute this month, where we wrap up January, we look forward to February, and we answer a very important question that I'm getting a lot. And that is the question you see before you: is the 6-year bull market coming to an end? Before we address that question, let's wrap up January for all of you. And, this is the visual that I will throw up for January. And why do I throw up a big picture of a beautiful-looking bear? And that's simply because I've received so many questions and emails as this month has gone on, asking that same question: is the bull market over? Right? Are we now bearish? Should we now implement bearish strategies? And to answer this question, I want to put it into perspective. This January that we've just completed, I want to put it into perspective by first looking at the numbers. We'll look at the global markets, and we'll look at the January returns. First, for the S&P 500, you can see we were down 2.32%, which brought up all those questions about being in a bear market, right? It wasn't a great month for U.S. equities. However, for the developed non-U.S. Markets, that would include Europe, that would include Asia, that would include Australia, that would include these developed countries that are not in the U.S., great month, 1.65%. And in fact, the emerging markets, China, India, for the most part, those two countries, also includes Brazil, South Korea, some other countries like that. Another great month at 1.5. I shouldn't say another great month. They had a great month in January at 1.52%. So as we look at the global markets and as we peel back kind of the layers of that question that I'm getting about the bear market coming, that wasn't the case globally. And in fact, if we look and compare this January to last January, and you see there the developed non-U.S., of course, led the globe. But if you compare this January to last January, substantially better month. We were down 2.59% in 2014 in January. The developed non-U.S. was hammered, down 3.5%, and the emerging markets was almost down 5%. You could round and say down 5%. So globally in 2014, January was horrible. And I can see asking the question about bearish markets more last January than I can this January. And the other thing that I like about the month that we just had was that you finally have these global markets showing strength. They haven't shown strength for a long time. In fact, I've received some other questions regarding that, saying, why in the world would you invest globally when the global markets are getting hammered? And you got to remember that the markets, the global markets, there's ebbs and flows to it. One year you'll have the developed non-U.S. markets outperforming the U.S. The next year, the U.S. may outperform it. And so you've got to always look globally and invest globally. In fact, I was just looking at some numbers. And in 2011 and 12, the developed non-U.S. markets outperformed the U.S. by right around 15%. So you've got to look global as an investor, which is the name of our firm, right? We're global investors. And kind of an interesting look as we compare 2014 to this last month we just had. And this last month we just had was a lot stronger. So let's put things into perspective as far as, is the bear market coming? All right. January sector recap. Let's look at the returns. I'm going to highlight not all of them, just a few things. We had utilities and we had healthcare that were leading the market. Those are defensive names, and these are U.S. sectors, and so that makes sense based on the month that we just had. If you recall, from a historical probability perspective, consumer discretionary and industrials tend to outperform this time of year, and they still are outperforming, but healthcare and utilities are leading the way. What dragged the U.S. down this last month were the financials. 5.46% and the S&P 500 is heavily weighted in financials, so it dragged it down. And there's a lot of financials that are at a great value right now. And we're scouring that market, as a firm, looking for more potential opportunities there. But you've got to be careful, understanding the headwinds that might face that sector. All right. And then on the right-hand side, we'll just keep track from here on out. For the rest of the year, we'll keep track of that year-to-date return and see which sectors are performing best, and we'll highlight what sectors we think will perform best. Right. So that's a sector recap. Now, what I want to do right now is continue and maybe answer this question to the best of my ability. You got to keep in mind, as we address this head on, is this the end of the bull market? You've got to keep in mind that no one knows for sure ever. That forecasting the market is a very difficult thing to do. And everybody could be dead wrong, right? Or everybody could be dead right. You never know for sure. And so what we like to do at Iron Gate Global is we like to look at history as our guide. Because if there's trends historically, then that helps put the probabilities on our side if we can invest with probabilities. And let me illustrate what I mean. I'm going to bring up a kind of a table by S&P Capital IQ, and receive this from Sam Stovall, who's great, who talks about this all the time. And I just want to illustrate something that he highlighted before. And so what you see in this table is on the left-hand side, you'll see the average S&P 500% changes. On the right-hand side, you'll see batting average, which is probabilities. Okay? And all these numbers that we're looking at, year 1, year 2, year 3, year 4, it's a presidential cycle. And so that's year 1 of a president's cycle, right? Year 2, we're in year 3 right now. And so as we look at year 3, which is highlighted, you'll see a couple interesting things, and it's dissected by quarter from Q1 down to Q4. Right, so I want to focus on that left-hand side, looking at the presidential cycle, year 3. In Q1, on average, now this is since 1945, right? So study history to help with probabilities. So year 3, Q1, we're averaging about 7%, Q2, 5%, Q3, 1%, Q4, 2.9%. Your average year 3 of a presidential cycle is 16.1%. That's pretty darn good, right? So if we were to say, just based on historical numbers, historical probabilities, we're expecting another big year in 16%, right? Now, I'm not saying for sure that we're going to do 16%, but I like the odds, which takes us to the right-hand side of that table. Batting averages as they present it. You've got a Q1, you got an 88% batting average, or say 88% probability. And across the line, 76, 59, 71, for a total of an 88% probability that we're going to hit around 16.1%. Right? Now let's put this in context. If there's an 88% batting average, right, or probability, then there's a 22% likelihood that it doesn't happen. So that exists, and we've been hit by black swan events, as they're referred to before, those low probability events that happen. And so we will continue to manage portfolios and be careful and look for these headwinds that may come. But when you're looking at probabilities, the probabilities say, no, this isn't the end of the bull market, right? This is year 3 of what historically is a great time to be invested. Okay? So, in fact, if you look at it, and let's continue this theme of history, and let's look at February, and this is 1928 to 2014, just average returns for the month, and this is a flat month for the most part, right? So the probabilities are that February will be, right around unchanged. So from an expectation standpoint, now we could be wrong. I look at January. The average return is 1.2%, and certainly the last 2 Januaries we have not received that. However, we don't take 2 years. We take a whole lot more than that, and this is 1928, 2014. So don't get high hopes up for February, because normally it's not a great month, right? And so what are we doing in February? What should we be doing knowing that the market is not great? Well, one thing that we like to do as a firm, or one strategy that we like to implement as a firm, is called our alpha strategy. And the goal of our alpha strategy is simply this. The goal of any alpha strategy is to reduce portfolio volatility and enhance returns over time. And I drew it. It's not based on numbers or anything, but I drew that red line. That's similar to what our alpha strategy seeks to accomplish. And we sell options and we use options for this strategy to reduce portfolio volatility. So for example, if in 2008, which was this huge cliff, if you can see my little mouse pointer here, if we apply this strategy and take the necessary changes to the portfolios, but in large part we apply this strategy, then we're not suffering that huge drawdown in our portfolios because we're managing the portfolios correctly. And so you can see that it does reduce portfolio volatility, but it also, in bull markets, significant bull markets, as we apply it, then we may underperform the market. And so it's give and take. Our alpha strategy is give and take, but for a given month like February, because the historical numbers are, it's not a great month, we'll apply it to hopefully reduce portfolio volatility and enhance returns at the same time. Now, we have more on this strategy as well on our website. You can go to the education tab on our website. You can learn a whole lot more about this strategy, or feel free to contact me anytime to talk about it. Basically, we're selling vertical spreads, if you know what that means, against our portfolio. That is our alpha strategy, and more than happy to talk about it a little bit more with you. So in summary, I would say this, as we end kind of our market minute today. In summary, I would say this. We're expecting a good 2015 based on probabilities. February may not be that great, but the rest of the year should be. Now, we will take the necessary steps in the portfolios. We'll continue to scour looking for value. We'll continue to apply options as needs be to these portfolios. And if you have any questions about any of that, feel free to give me an email. Pop me an email, brett@igga.com. You can reach us at the phone, 888-591-0334. My Twitter, you can connect with me on Twitter and LinkedIn, and also more than happy to talk about, again, anything that we addressed today. And as far as the outlook goes, we're very optimistic of what the future holds, and I hope you are as well. With that, thanks for listening. We'll see you next month.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.